In this video, I'm going to finish covering the flexible budget from exercise 1634 and also address a profit variance analysis report from 1635. So you'll see here, this is the profit variance analysis report from exercise 1635, but it also includes the same flexible budget information from exercise 1634. So just make sure you've also transferred that information into exercise 1634. And if you recall from our prior video, the total sales activity variance was identified as being 270,000 unfavorable overall for the company. And follow the instructions, they identify that we need to divide, everything's been rounded to the 1,000. So we need to take the 270,000 divided by 1,000, we'll leave 270. And again, this is unfavorable. Again, that's the total sales activity variance for operating profits overall. I'm going to go ahead and jump up here and start with sales revenue and fill in the master budget information for sales revenue. Recall that I'm going to take the planned level of activity for the master budget, and instead of using 100,000, I'm going to divide that by 1,000 because we're rounding everything and list that as 100 times the budgeted selling price is $75. And so again, this really would be $7.5 billion, but rounding it, taking away that extra 1,000, would leave it as 7,500. For a flexible budget, if you recall from the last video, instead of multiplying our $75 selling price, we're going to use the same selling price times the planned level of activity, we multiply it times the actual level of activity for the finished goods. And my prior video explained that that was 94,000 units. Again, dividing by 1,000 would be 94. And so that would be 7,050, or really 7,050,000. So our sales activity variance, we simply take the flexible budget of 7,050 minus the master budget of 7,500, and we have a $450 difference. But I have to identify, is this favorable, unfavorable? What I tend to find is students often are able to calculate the number correctly, but the problem turned into the interpretation of unfavorable and favorable. Now, sometimes I get into positive or negative numbers. So in this particular situation, it is a negative number. So sometimes people will go, okay, well then that makes sense. It must be unfavorable, and it is unfavorable. But I also say step back and really think about this. My actual number of liters I sold was 94,000 or 94. I thought I was going to sell 100 or 100,000. That's less. That's not a good thing to have less sales revenue. Now I'm going to jump down to materials. Again, starting with the master budget, my original plan was to sell 100,000, or 100 if I divide it by 1,000, times the cost of direct material per liter, which is 2 pounds times $4 per pound is $8. And so that would be 800, or again, really 800,000. For flexible budget, I'm going to take that same $8 per finished unit, but multiply it times the actual activity, again, really 94,000, but here we're using 94, and so that would be 752, or really 752,000. Now, as far as subtracting the difference, 752 minus 800, that's 48. But again, here's where I see things go wrong. Folks will look back up at this one and go, well, in sales revenue, flexible was less than master and it was unfavorable, so then we'll follow the same pattern. Material flexible budget is less than master budget, so it must be unfavorable. Nope, it is going to be favorable. The rules flip around when we get to cost. So again, step back and think about this. If my actual activity here, 94,000, is less than my plan, my cost should be less, correct? And if my costs are less, that's actually a good thing. So the rules flip around. And here, if it happens to be negative, it's favorable when we talk about cost. If it's a positive difference, flexible minus master budget, it's actually an unfavorable, a bad thing. So just keep those rules in mind. Now, I'm not to keep the video as brief as possible, and also not to give away all the answers. I'm not going to work through direct labor and variable overhead. The only thing I'm going to comment is I also expect those to be favorable variances for sales activity, just like we had for my materials, because the only thing that driving the difference for the sales activity variance is the volume difference of 94 versus 100, and that's the same no matter if we're talking about materials, direct labor, or variable overhead, or any other variable difference. So that pattern is going to hold. If we'd had a situation where our actual activity was greater, let's say it was 104,000 or 104 versus 100 or 100,000, then I would have flip-flopped all the signs for these sales activity variance. The sales revenue variance would have been favorable because, yeah, it's a good thing that we sold more units and that's going to drive more revenue. But our cost variances for any variable item would have all been unfavorable because that would have driven us to have a higher cost, and that's a bad thing. So that's an overall pattern. I'm going to jump down and at least fill in one of the fixed costs. And in fact, I'm going to fill in fixed manufacturing. Again, I'm going to start with the master budget. I'm going to jump back up here and it says a fixed overhead rate at the master budget level activity, which was 100,000 liters, is $10 per unit. So again, dividing that by 1,000, $10 per unit times 100, really that should be 100,000, is 1,000. Again, really that should be $1 million. Just filling it in according to how Connect wants us to enter it. So do I take that $10 per unit and now for flexible budget, multiply it times 94 because that would follow the same pattern that I did for the variable cost? Nope, you have to step back and think about the typical rule of thumb for fixed costs. We don't expect them to change based on the activity level. So whatever I originally planned for the fixed cost, $1,000, is also what I would expect for the flexible budget because I wouldn't think that small of change of activity within the relevant range should change it. So all of the sales activity variances for fixed costs should be zero. The original plan and the flexible budget should be exactly the same. Now, again, gonna allow you to fill out the rest of these. What I want to do is now focus on our left-hand side, so our columns that aren't highlighted here, in order to fill in the rest of the variances. So for other variances on the left-hand side, we are going to use the flexible budget. Okay, so that's going to become our right-hand column for that side. But we're going to compare that to the actual results. They give us the actual numbers and a separate income statement. And again, we're going to use those rounded numbers. And you can probably notice on the video you saw some changes here that my calculations went away. I'm just trying to make it as non-cluttered as possible. Now I want to step back. Depending upon where you took your intro to managerial accounting, you might have seen some differences here. When we covered the difference between actual results and flexible budget results, we called them revenue and spending variances, and we just had one column. We complicate things a bit more in this book, and they break those revenue and spending variances up in different columns. They're like, okay, so for the sales revenue, actual minus flexible budget, we'll call that a sales price variance, and we'll fill it in this column here. For any manufacturing related costs that include our materials, labor, variable overhead, and fixed manufacturing, we'll fill that in the manufacturing column. And for any non-manufacturing costs, which the only one here, they didn't have any variable non-manufacturing like selling administrative, is the non-manufacturing, and that would go in the non-manufacturing column. So they just split up what we traditionally knew as spending and revenue variances in one column into three separate columns, depending upon the category of the cost. Again, still actual minus flexible budget. So let's do at least a couple or a few together. Sales revenue. Again, I'm going to go left to right. Actual cost is $7,238, and I know it's hard to see all the way over here, compared to or subtracting the flexible budget of $7,050 is a $188 difference. Again, what's the interpretation? Is this good or bad? Step back. If the actual sales revenue is greater than what we thought it would have been, still acknowledging that both of these are at the sales activity level of 94 and 94,000. If it's greater, then that's a good thing. So this is going to be favorable. Materials. Actual material cost is 748 versus the flexible budget of 752. The easy part of this, make sure we fill in the right column under manufacturing, is it's a $4 difference. Again, keep in mind, this is where the positive negative things flip around. Again, you may look at this and say, well, this should just be opposite of this because this one is higher here, this one is actually lesser, but this ends up also being favorable because we're talking about a cost now, not revenue, and a cost is a bad thing, whereas a revenue is a good thing. It's a good thing that our material cost is less than what we thought it would have been at the same activity level. That's actually a positive thing. So that's going to be favorable. Now, I do want to stress again, sales activity variances only have to do with the activity varying 100,000 versus 94,000. On our other side here, that has nothing to do with activity level variances because both of these numbers, actual and flexible budget, are based upon that actual $94,000 activity level. But then you may say, well, what's causing the difference? For materials, it could be one of two things. It could either be, we look here, $8 per unit. It could either be we happen to use less than 1 pound, and I don't know if that's a good or bad thing, if that affected quality, or it could have been we were able to negotiate a better price or change the vendor and we didn't pay $4 per unit. Now, we're going to have a separate video and separate calculations to narrow that down, but it could have either been the input quantity, not finished good quantity, or the price per unit could have affected that. Now, I at least want to tackle one more, and similar to what I did for a sales activity variance, let's also do fixed manufacturing. So actual cost is 1,050 minus our flexible budget is 1,000, and that's 50. And again, we're talking about a cost here, so it being greater than what we thought it should have been at that activity level is going to be an unfavorable. I'll note here that you may say, wait a second. I remember being drilled in on, intro to managerial accounting and also your cost accounting that if it's a fixed cost, it shouldn't change based upon the activity level. And you explain that here, a master and flexible budget was 1,000. So how is this 1,050? Something other than the activity level ended up changing our fixed cost. So this might have been a situation where this included maybe perhaps rent on our plant. And while we didn't end up, expanding or anything based upon activity level, the landlord just charged us $50 more, and that was unanticipated, and that might have affected. So hopefully this is a good starting off point to get you started so you can fill in the rest of your profit variance analysis report. One more quick note that I forgot to mention before I go. For sales activity variances, I described a typical pattern we'd expect because it was only the activity, sales activity driving that difference. There's no pattern that I would expect. And what I mean by that in terms of favorable and unfavorable variances, so there's no necessary pattern, material manufacturing variance can be favorable, whereas direct labor variances can be unfavorable. So there isn't consistency in the favorable or unfavorable here on our other side.